Welcome to a new explainer that dives right into one of the most perplexing financial mysteries in the market today, AT&T. Look, if you hold any dividend funds in your portfolio, there is a very good chance you already own a piece of this puzzle. We're looking at a company that is flashing some incredibly attractive metrics while simultaneously setting off massive, unavoidable alarm bells. Let's break down exactly what's going on beneath the surface of America's largest telecommunications company. Right out of the gate, we are hit with this massive paradox. On one side of the scale, we have these mouth-watering, multi-decade low valuations. We're talking a price-to-earnings ratio of 7.6, an incredibly generous 4.8% dividend yield, and a highly profitable 18 to 20% return on equity. Sounds amazing, right? But weighing down the completely opposite side of that scale is a terrifying mountain of debt, $126 billion to be exact. So we need to figure out how these two totally opposing realities manage to coexist. Here is our roadmap for today. We'll unpack the ultimate value paradox, uncover 7 hidden red flags, reveal 9 massive green flags, run this through the investing legend gauntlet, settle the great moat debate, and finally, give you the final verdict. Section 1, the ultimate value paradox. Now, if you haven't looked at AT&T in a few years, you should know they've completely stripped out their media assets, stuff like Warner Media and DirecTV, just to focus purely on connectivity. Advanced connectivity actually accounts for about 90% of their revenue now. And right now, trading near a 52-week low of around $23 a share, the company has a price-to-earnings ratio of just 7.6. To put that into perspective for a second, that is roughly half the S&P 500 average. Combined with a price-to-sales of 1.2 and a price-to-book of 1.4, it looks incredibly cheap. Honestly, almost too cheap. Which brings us to section 2, 7 hidden red flags. Okay, let's validate some of the market's skepticism here. If we ask the father of value investing himself, Benjamin Graham, his ultra-conservative intrinsic value estimate, which is known as the Graham number, prices AT&T at just $18 a share. That means at the current price of around $23, it's actually 28% overvalued by his strict standards. That is a huge, blaring siren for anyone out there looking for a true margin of safety. Furthermore, the company has this really frustrating one step forward, two steps back problem going on. Yes, they are seeing a solid 5.1% growth in their 5G and fiber segments, but that progress is getting dragged way down by a brutal 25.9% collapse in their legacy wireline business. Because of that monumental drag, total overall revenue growth is just limping along at 2.3%. And the bear case just keeps going. They have a dangerously low Altman Z-score of 0.96, which is a classic metric signaling elevated bankruptcy risk. And that's thanks entirely to that $126.4 billion in net debt. There's also the emerging direct-to-phone threat from SpaceX's Starlink. Some analysts genuinely fear this could be a Kodak moment that totally disrupts AT&T's wireless pricing power. Throw in practically non-existent insider ownership at just 0.10%, massive annual capital expenditures eating up $23 to $24 billion, and a 1.3% drop in fiber average revenue per user. Well, it paints a very clear picture of why the market is a bit spooked. But wait, let's pivot to section 3, 9 massive green flags. Because there is a very good reason contrarians are absolutely salivating over this stock right now, and it all starts with a ridiculously safe 4.8% dividend. Now, usually, sky-high yields are a massive warning sign of an impending cut, right? But AT&T's dividend only consumes about $8 billion. That is just 44% of their projected $18 billion in free cash flow. For income investors, that massive 235% coverage ratio means the payout is incredibly well protected. Beyond that ironclad dividend, the company is churning out 18 to 20% returns on equity, and their advanced connectivity growth is actively accelerating, hitting record fiber customer additions. Plus, management has a massive multi-year plan to return over $45 billion to shareholders by 2028 through dividends and buybacks. Add in an AI-ready network that's partnered directly with AWS and a super low beta of 0.42, making it way less volatile than the broader market. And honestly, it's no wonder analyst consensus leans toward a buy with roughly 24.5% upside. So how do we weigh all this? Let's go to section 4, the investing legend gauntlet. With such wildly conflicting data, the best thing to do is just force these financials through the strict criteria of 3 legendary investors. Benjamin Graham, he's a hard pass. There is simply no margin of safety for him, with the price sitting well above his $18 intrinsic value. Peter Lynch, on the other hand, would likely be cautiously optimistic. He'd absolutely love the low PEG ratio of 0.91, which highlights exceptional value relative to growth, but he'd hate that sluggish 2.3% overall revenue drag. And finally, Warren Buffett is a partial fit. He'd be all over that massive cash flow and 18 to 20% ROE, but his notorious aversion to high leverage means that $126 billion debt pile would almost certainly be a total deal breaker. Speaking of Buffett, that brings us to Section 5, the Great Moat Debate. Buffett's whole framework really hinges on competitive advantage, and that sparks a huge debate among financial analysts. Morningstar argues that AT&T's moat is strictly narrow. They point to fierce, cutthroat price wars with competitors like T-Mobile and Verizon, alongside the punishing need for constant, massive capital investments. But then you have Guru Focus rating them with a wide moat. They base that on the sheer scale of AT&T's infrastructure, massive brand power, and deep, super sticky enterprise relationships that would cost tens of billions of dollars and years of effort for any new player just to replicate. All right, bringing it all together, Section 6, the final verdict. Synthesizing all of these totally conflicting viewpoints leaves us with a few ultimate questions. First, can management actually pull off deleveraging the balance sheet down to 2.5 times earnings by 2028, especially while their leverage is currently spiking to 3.2 times? Second, will that accelerating 5.1% growth in 5G and fiber finally outrun the massive 25.9% collapse in the legacy wireline business? And finally, is the threat from Starlink's satellite service just a bunch of noise, or is it a fundamental disruption to their pricing power? Now, if you're sitting on the sidelines, there's actually a bit of a unique urgency here. If you want a piece of that massive free cash flow, the ex-dividend date to capture that 4.8% yield is approaching super fast, well ahead of that distant but absolutely critical October 2026 earnings check-in. So right now is really the time to evaluate the risk versus the reward. So we leave you with the ultimate question. Does a historically cheap 7.6 PE ratio and a rock-solid 4.8% yield justify taking on a $126 billion debt burden in an incredibly cutthroat telecom landscape? Is this a value investor's absolute dream or a classic devastating value trap? Think it over, do your own research, and we'll catch you in the next explainer. Stay sharp.